Hi, Said. Good evening, and thank you for the question. You've asked, hi, can you please explain how to make directors loan to own limited company, please? So let's imagine a scenario just to bring everyone else into the picture. But it is possible whereby you set up a limited company to buy a buy-to-let property. Okay. And what will happen, let's say use round numbers, I think is easier. You have a property at £100,000 and you can get a buy-to-let mortgage for £75,000. But where, Louise, do you get the extra 25,000 from, apart from the lottery tickets?
Well, yes, lottery or magic, that would be very nice. The alternative, of course, is you might lend your company some cash that you have built up as reserves. And the process of lending that money to your company to pay the deposit is, drumroll please, a director's loan.
So that's how you do it. So ultimately, what will happen, Said, is that you would loan your company that £25,000 as an example. And to boot, Louise, there is an extra benefit of being able to charge it interest. And that interest that you charge the limited company will receive a corporation tax credit, or not refund, but it is a credit of sense. From an income tax perspective, on your personal self-assessment tax return,
my favorite topic,
because we're going to say that a lot more from in this show, tell everyone about why it's good to have an outstanding loan.
Well, for me, lending money to your company and then receiving interest as income in return for having given that loan is a win-win. The reason it's a win-win is Simon's already said the first win, and that's because arguably any interest that your company is paying to you is a tax-reducing expense to your company in the calculation of corporation tax. That's the first ka-ching. The second ka-ching is that if you receive a certain amount of interest every year, and let's say that interest only comes from the director's loan, then depending upon which tax bracket you're in, you can receive some interest completely tax-free as well. That is the second ka-ching, and therefore that's why for me it's a win-win. You do have to, as you would imagine, jump through a whole host of hoops administration-wise to capture that level of detail. And of course, I would recommend that you talk to your tax advisor stroke accountant about that paperwork before you commence that process of A, lending the money, and B, perhaps receiving a return via interest. But they're very straightforward. And as I say, it's a big win-win. So definitely worthwhile looking at. So great question. Thank you.
Hopefully that video was useful for you, but please do not stop there. There are plenty of videos that I know that will help you build your wealth whilst reducing your tax liability. And in this video, well, this is the one I think you should be watching right now.